Bloomberg Audio Studios. Podcasts, radio, news. This is the Bloomberg Surveillance Podcast. Catch us live weekdays at 7 a.m. Eastern on Apple CarPlay or Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Right now, Claudia Sahm joins us, Chief Economist at New Century Advisors, her PhD at Michigan, with the giant of inflation analysis, Matthew D. Shapiro. Claudia, I got to get this out of the way before we go to jobs. You are acclaimed for the Sahm rule. There seems to be a bet of slowing GDP. Are you in any way on a recession, not an NBER recession, but are you with the Sahm rule in any way looking at a new analysis of slowdown?
So absolutely looking at the labor market, any signs of slowdown. We are not at a place where we're close to kind of that historical trigger for the Sahm rule. I mean, we would need to see the unemployment rate probably rise this year up to 4.5% before we start to get kind of in that danger zone. But of course, there are certain, sectors looking at something like the government sector, we could see a contraction there, and it doesn't necessarily have to show up as a national contraction. So there's a lot to watch in the labor market in terms of things.
Claudia, with revision, I got 2 months, and we'll get much more later, of 138,000 60-day run rate. Is that a buoyant job economy?
I'm not sure I'd use the word buoyant, but these numbers at a first look are, they're solid. They're showing the difference between 150,000 and 160,000 on the month is not let's be real about the statistical precision of what we're doing here. But it's not it's kind of at trend. Right. We're treading water. The unemployment rate ticked up as a tenth, but again also staying very low. So I think this report we should see a lot as a baseline before we're headed into what has been a very chaotic period with tariffs and with the DOGE action. So, the better this was today, that's more resilience. So it's great. It's not great, but it's good. Well,
I got a futures lifted on it, Paul. Yeah. Can we describe how unfair it is to Claudia Sahm and Ellen Zenter to warble gaily here with the data coming out? The Greenspan statistic, Paul, the underemployment rate from 7.5% last month out to 8% this month. Yep. So that's just one tea leaf within the bucket of the ship of tea.
Yeah, a little bit, again, on some of these revisions coming in lower from last month as well. I'm going to put that in context as well. Claudia, how do you think the Federal Reserve will look at this data print here today?
I think so I don't see anything here that will change their near-term course. So they're not set up to be cutting interest rates. I don't, this doesn't, a really negative print might have, a really weak print might have kind of pushed some of, the growth issues might come up more quickly. I think this still puts them in their wait and see path. This is not that far off of expectations. Right. This is a sustainable number.
And we see it within the market with 10-year real yield lifting up. Futures come up a bit. VIX is better behaved. Yep. Claudia Sahm, thank you so much. Please call us if the Sahm rule clicks in here anytime. 24/7 we'll take that call. Claudia Sahm with New Century Advisors. With us in the studio right now, we are honored to have one of the best students of the American consumer in American economics. Ellen Zenter joins from Morgan Stanley. Let me go to the wheelhouse, Ellen, before we get to the jobs day. Mm-hmm. With the absolute historic moment, including inflation, sea change in Japan, the Europe of yesterday. I can't imagine Morgan Stanley economics in the last 24 hours. Is there a resilience to the American consumer?
There's a resilience depending on what income group you're in. And the thing that I'm concerned about is that we've had all our eggs in one basket for some time now with the wealthy propping up aggregate spending in the U.S. And with tariffs coming on goods, it's going to disproportionately hit lower income groups, create that continued drag on them. The wealthy groups probably won't be there to pick up the slack in good spending. We're spending on services, right? And services aren't where tariffs are hitting.
So in 2025, I know one of the themes, and you guys think about the big themes out there that could be moving the market, and we did not see it necessarily in this jobs data, but if you're going to have tariffs potentially a negative impact on growth, economic growth, maybe an impact on inflation moving higher. Changes in immigration also maybe having some inflationary and some growth issues. When do you think we'll start to see that in the data? Is that a second half of 25 issue?
Yes, I think depending on, which I don't know what's going to happen from day to day, hour to hour, minute to minute. Exactly. But depending on when tariffs are put in place, and we know already they're coming through from China. The reason why the Fed has to remain data dependent is because tariffs fall here, there, and everywhere. And you don't know how much of it is going to be absorbed by manufacturers along intermediate goods route or to final goods for consumers. And so you just have to wait to see what happens. I suspect that households in the U.S. are not indiscriminate buyers here, that we do have a degree of price tolerance, and that you are going to get a hit to aggregate demand. And as a policymaker, you should look through that, the price effects, because eventually they're going to come off because demand is going to be lower. So for the Fed, the big question now, and I guess for all of us in the economics community, is that terrible word stagflation. Yep. Does the inflation come before the stag or the stag before the inflation?
Your claim, away from the 3 zip code focus of this show, Manhattan, Wall Street, all you have to deal with, frankly, at Morgan Stanley, is the charm of Austin, Texas, entrepreneurial Texas, and your work at Colorado, Denver. I mean, you're not from here. Can the rest of America withstand this tariff discussion? Do you look at America as one whole within the cacophony now, or are we separate, resilient, and discrete from the political fire and heat?
No, I think that tariffs are something that hit very broadly. Now, obviously, you've got states that are going to be much more heavy importers for intermediate goods. And so I'm thinking of my state like Texas is more exposed there than, say, New York. But it will impact businesses of all sizes everywhere, and especially small and medium businesses cannot absorb the cost increase as much as large multinationals. Look at the New York Fed survey that came out earlier this week and noted that businesses in its region across services and manufacturing were expecting cost increases. And then you read the comments within the survey from that survey and the ISM manufacturing survey, and there's complete uncertainty about the supply chain impacts and where and how do you absorb those costs. And it's uncertainty itself.
Yep, that's right.
They can start dragging down the economy before tariffs actually hit.
So given that background, would our Federal Reserve say, let's do a preemptive cut?
No.
No. Okay.
Absolutely not.
So they're going to wait to see the hard data.
Yeah, and the data's not rolling over. Look at the payroll report today. It's not rolling over. And so what you need to gain consensus on the Fed to move is something obvious, so that these two sides, that those that would want to maybe do preemptive or think that rates are a little more restrictive than they should be versus those that think we're hanging out here in a perfectly fine level, something has to slap them across the face and say, oh my God, we need to move. And something like today's payroll report or what we're expecting on inflation prints is not going to do that.
In honor of Booth School Chicago, there's a wonderful seminar today. Jerome Powell with comments for Bloomberg. We'll have that sometime after 12 noon. This is the panel I was not invited to. Are you going?
I'm going.
You're going. I'm not. Lisa, are you going? Everyone else is going.
I guess I got to join the party.
I'm getting a free ride there from Bloomberg. Your car is taking me there after. Yeah.
That used to be Tom's
That's how I roll on Fridays.
The key is going. I'm not going. Did you notice that, Michael Ferroli? Thank you so much. Ellen Zenter, Frank Knight, 1921. We all had to read it. They put a gun to our head and said, read this or you can't
But
move
not
forward.
many of us read it in real time, Tom. Tell me, what was that like
It was
when it
really
came out?
like your wise ass. Okay, 1921, Frank Knight. I want you to describe Knightian uncertainty to our audience worldwide right now. It's not like Risk. It's not like Las Vegas, is it?
No, it's very, it can be very pervasive if it's sustained. Now, in the 20s, and on through, say, the 70s, right? Uncertainty would be reflected in sentiment, and it told you exactly what businesses and households were going to do. And I'm talking specifically about University of Michigan, the rise of the sentiment surveys in the 1950s onward. Today, uncertainty impacts sentiment, but it doesn't necessarily tell you what you're going to do, right? My husband will tell you that I shop when I feel great. I shop when I feel like hell. Okay. But if it is sustained at high levels, it will start to permeate business investment decisions, household spending decisions when people can't plan. And I'm looking at the Trade Policy Uncertainty Index, which has gone through the roof. And it has surpassed the previous record set in August of 2019. And that is what you're seeing in these surveys. And businesses are saying, I can't do this.
So we got to use the surveillance sentiment indicator. Are you going to be at Fendi Friday afternoon?
No, I'm probably tapped out on goods spending. I've also been warned by my husband that I went a little too far late last year. So I would short luxury retail stocks because Zenter has closed her wallet.
Well, there and JP Morgan actually out of the report saying enough on luxury right now. We'll see how that works out over the last number of months. Let's get back to Jobs Day one more. You're going to write about this, Seth Carpenter team, you and thematic investing. What's your message pre your written report on this jobs report? I believe you just said, you know what, it's resilient.
So today it's still showing resilient numbers. Now, there are a lot of folks that came in this report and said this report doesn't matter because federal layoffs have only just begun and it's going to really be reflected in the next report. So you are going to get deeper cuts to federal in the next report. We saw a drop in participation and still the unemployment rate went up. That's an interesting combination, probably reverse next month. I'm looking for big outflows from labor supply because of immigration. We have not seen that switch yet, even though for 6 months we've seen a really big drop in flows.
You want to stay? This is going to be a clinic. Rebecca Patterson's going to join us right now with the Council on Foreign Relations. Ellen, if you want to stay, please do. If you have to go to the Booth School panel, which I was not invited to, please leave.
I've got to get my free
card.
Breakfast. If not from Bloomberg, then from Chicago Booth.
Okay, well, the Sweeney
it's free
breakfast
this morning.
The Eggs Benedict is
Thanks,
upstairs.
guys.
It's great. Joining us now, Rebecca Patterson, after Ellen Zenter as well. Rebecca, I got to go to currency market as litmus paper, the system. Do we have a new dollar entrenched given this political chaos?
I think for the short term we do. The question to me is, does it continue? I think the dollar is down against most peers this year because of worries about growth. And we're seeing that reflected in interest rate expectations for Fed funds. So now 3 cuts this year. So the yields coming down and Fed funds coming down, Fed fund expectations coming down is bringing down the dollar. But the other part of this, Tom, that we're seeing, I believe, is repatriation. The last 10 years, foreign investors thought the U.S. was the only game in town. A lot of capital came here. They helped prop up our stock market. They're taking their toys home. So they sell the dollar and they sell the stocks, and then they put it back in their home markets, whether that's Japan, Europe, et cetera.
I had lunch yesterday. I had the number 3 value meal. It's really, it's really good with the fries. Ambassador Haas was sitting next to me, of course, inventing the modern Council on Foreign Relations. And what Richard Haas would say, Rebecca Patterson, on that is it all devolves back to China. Is China part of our domestic financial dynamics now?
It has been for decades. I mean, about 16% of our imports come from China. So if China is continuing to cut prices to make its good more attractive in foreign countries like the United States, we're going to import that deflation to a degree. To a degree.
Yes.
And then right now, and this is a really interesting topic, not to get too far away from jobs, but we are going to see lower, well, here's the trick. Do we continue to see lower import prices with the tariffs? We had been. Over last year, import prices, we had deflation in them. That should change now, right? But not necessarily from China per se. And then we have lower oil prices that deal with Saudi to get OPEC to increase supply. Oil prices are down almost 10% year to date, although I think they're up a little this morning. But then on the other side of things, as Ellen was just pointing out, if we start seeing immigration turn negative, the labor market's tightening, that's going to be an underlying support to wages. So we have these cross currents going on, and I think it's going to make the inflation picture muddy. And to me, that's still the main priority for the Fed. And I think we'll hear that come through from Chairman Powell today.
Treasury Secretary Scott Bessent is making the rounds of media and various and he's talking about how he likes lower yields. We're getting yields. I'm not sure this is how he wants these yields to go down, but we are getting them lower, I guess.
It's interesting. And I respect anyone in public service, and especially to take a job as difficult as that. But on one hand, you're hearing Bessent say, well, the economy isn't ours yet. We need 6 months, 12 months before our policies are reflected. And at the same time, he's doing a victory lap on lower yields. Well, you own it or you don't. But the lower yields, to your point, I think are coming primarily because of worries over growth, not happiness over deregulation and inflation.
Stay with us after the jobs report on your commute across the nation. Good morning to the West Coast. Waking up on YouTube, subscribe to Bloomberg Podcasts. It's where Rebecca Patterson watches us. She's with us with the Council on Foreign Relations. And Paul, all I got to say is I got a lift in the market, but then it fades. The VIX 25 into 24.27. Anything as good as a Sweeney yield in 4 basis points. I mean, can I say it's a jumble? I mean, it's not news-making, but that's sort of what we got today.
No, we've kind of lost a little bit of that lift off of it. So I guess, Rebecca, for better or worse, we're left to an economic policy that's driven in large part by sound bites as it relates to tariffs. How do you kind of frame out the whole tariff discussion for clients, because it shifts every single day?
Yeah, I mean, and you all talk about this so well and thoughtfully, but the key word is uncertainty, right? We have a tariff, we get exemptions, we have a pause, it's still coming. April 2nd, the shoe will drop, you know, and so the fact that we don't have clarity on where this is going by direction, I think we do. Tariffs are coming, but how much, how fast, how big? And that causes consumers to get nervous, and they're pulling money out of stocks, and it gets businesses nervous. And that goes against this whole idea of Trump's relaunching of animal spirits. Which was real, I think, after the election for a number of weeks. Yes, it felt real. People thought we were going to have deregulation. It was going to help M&A and IPOs, and that would support the stock market and the economy. And I think that is all still possible. But right now, that's on the back burner, and the front burner is trade policy and deportation and what all that means.
The Budget Lab at Yale has, after the gyrations, a depression of negative 0.4% on the GDP number. I calculate that as a 16% hit to real GDP. Within the dynamic of that real GDP, somehow depressed, we don't know, and the mystery of inflation. For business people out there, like you sitting on the desk at JP Morgan years ago, do you just assume a dampened nominal GDP?
I think we have to assume a more moderate nominal GDP number this year. Absolutely.
How did Jerome Powell address that? He won't address that at the Booth School, Chicago, where I was not invited today.
No. Just in case you didn't hear that.
Yes, exactly.
What does the chairman of the Fed do with a new set of nominal GDP dampened?
You know, I think after the payrolls today and the recent data and the recent tariffs, he's going to just continue to say we're data dependent. We're watching. Right now, most of the impact from the policy uncertainty is coming through consumer and business sentiment. It's quote unquote soft data. We didn't see it really in payrolls today. We haven't seen it much in hard data. To the degree the coming months see the hard data, then growth becomes a bigger concern for the Fed. But right now, again, as Ellen and your other guests have said, to date, the real economy, the consumer, businesses have been resilient. Q4 earnings were very strong. So it's the question of, does the past continue? And I think increasingly the market's telling us they are nervous that it won't.
Do you expect growth to materially? Do you expect to see reports coming off the sell side on Wall Street? We're cutting our economic outlook. We're cutting our economic outlook. Our GDP call for 25, for 26. I haven't seen that much yet.
I've seen a few. JP Morgan, I know, has already cut its U.S. GDP forecast twice since the beginning of the year. I haven't checked every other bank, but I would assume there's similar trends underway at most shops. So it is a softer environment that's getting priced in. And it's important to remember that soft growth does not mean necessarily bad equity returns. You can have decent equity returns with moderate growth. You don't have to have booming growth. It's different types of companies that perform well, but we shouldn't panic.
Yep.
It's CFR Mario Ferragamo writing it up on fentanyl, Canada, Mexico. It's maybe outside your remit. What are you learning from the Council on Foreign Relations on the politics of the moment? What are you leaning over and reading a second time?
Well, the politics drives the policy, and the policy will then influence the financial markets and economy. And then the feedback loop goes the other way, right? What happens in markets, as we're hearing from Bessent about yields, then will affect the policy. when you mentioned Canada, Mexico, those politics, I do believe the administration appreciates the magnitude of hurt that could come to the United States from large prolonged tariffs on Canada and Mexico. And I think that's why we did see major exemptions and the pause. But I don't think we're going to get them back to zero anytime soon. The challenge is that we don't have the fiscal room this time to bail out industries. In 2018, the United States gave unprecedented subsidies to the U.S. farmers. We don't. Where are we going to get the money this time? From the new Bitcoin reserve?
Okay, you can stay with us because the Bond Girl just showed up. Kristina Campmany
Girl,
with us
excellent.
Is right now. Rebecca's clueless. I'm clueless. Paul's clueless. What is it? Paul mentioned it earlier. It was brilliant. Yeah. Is there a new vector to lower yields, or is it transient?
Look, I think it's still transient, and I think we're range bound, and I think you guys have talked about it this morning, and there is so much uncertainty. The one certainty we have is uncertainty going forward, and there's so many push and pulls of all of these policies, and we've gotten a lot more delivery of some of the growth negative policies so far, and inflationary policies and immigration, and we're really lacking still on deregulation. And I think your point on the fiscal support in 2018, we're talking about fiscal cuts now. So we don't have that cushion when we talk about supporting growth with all of these other pullbacks. And I think the market's patience on kind of the positive boost from dereg is waning thin at this point.
And you look at the bond market on a global basis, and there's changes in Europe.
Yeah, there's significant. It's been a massive,
unbelievable. Tom and I were talking. It's generational.
Yes.
Some of the things we've seen coming out of the announcements out of Germany and so forth. So does that shift maybe your focus away from the U.S. to Europe?
Yeah. So I think that there's a few things. So we're finally, we've been talking for a decade, maybe more, about really getting a step up in spending in Europe, certainly from Germany, and the willingness to have kind of fiscal support there. And even from the start of the Ukraine conflict, there was an expectation that you'd have more defense spending, and we haven't seen it. So I think it is really a meaningful thing, and you've seen yields in Europe reprice almost 50 basis points. I think there's some opportunities there. And then Japan is the other market that rates have moved tremendously.
It's truly historic. Rebecca Patterson, a question for Kristina Campmany of Invesco.
Yeah, so when I think about Europe stepping up spending and this huge move relatively that we've seen in the bond yields there, Germany can afford it. They still have relatively low debt to GDP ratios, relatively small deficits. Other countries in Europe, including France, Italy, on, can't. They can't afford to have suddenly higher yields. Do you think there's any risk that we could get the so-called Liz Truss moment, not in Germany per se, but perhaps in some of these other markets if this bond sell-off continues?
Spreads across Europe are still so historically tight that that's not an issue that we think is kind of on the precipice, even with kind of this reprice. So Italy, Germany is still 100, 110, I think yesterday when I looked at it. These are historically tight levels in the post-2011 European sovereign debt crisis. So I think you have a lot of room to get there. And I think the inflation in the last few years in Europe has actually really supported the fiscal situation.
First chart I looked at yesterday in the Bloomberg poll when I came in at 652 was Italy, Germany. And it hasn't moved.
Which is good. That's good.
It is.
So here's my other worry. Scott Bessent, our Treasury Secretary, yesterday and today, both at the European Economic Club of New York and then on another channel today, basically was trashing
another channel. It's the Death Star.
Well,
they call it the Death Star.
He's been on Bloomberg a lot. So,
thank you.
Yes, a lot.
Okay, but he's on the Death Star and he makes some amazing headlines. Continue.
So thank you. He's trashing the CBO, right? So this is the entity that scores our budget proposals, tells us what the deficit's going to do. It increasingly feels like if they don't like the answer from the CBO, they're going to say it doesn't count and move on anyway. It's not market moving, but at the same time, it's putting into question our institutional processes. Do you think bond investors eventually care that we're ignoring the math?
Yeah, we certainly do care. And I think the dialogue for the last kind of number of years, as you've had all these pressures, have been why are yields not higher? Why are we not pricing in some of these fiscal risks? I think it takes the rest of the world some time to get there. But I think all of these policy changes and kind of the change in tone from the administration towards the rest of the world, I think is changing the world order. It will have negative long-term repercussions of how the rest of the world interacts with the U.S. and thinks about it. I think there will be lasting effects.
Paul, try to get a question in here.
Well, Kristina, I just wanted to ask.
I'm taking over.
Are you dialing back your risk here to reflect the fact that we've kind of got a lot of uncertainty out there? Maybe we're not seeing it yet in the numbers, but it's out there.
Look, I think that there's been a lot of uncertainty leading into the election and coming out of the election. It's shifted what it is, like where the uncertainty is coming from. We still think, and I think you guys touched on it earlier, a lot of what's changed the narrative in the last week and a half has been tier 2 data. Like, we haven't seen a lot of weakness yet in the tier 1.
What's tier 2 data?
Meaning confidence measures, like not in CPI and headline, like the big numbers. So I think that there's still kind of, there's some disconnect there, and we've swung with the sentiment in the market has swung a lot more. So I think that there are opportunities, and it's a matter of, with these, like when you have volatile reprices, where are now the opportunities? There's some opportunity maybe more to own front-end European duration rather than the US with how much we've repriced.
Rebecca, is there a concern out there? Should we be concerned that, given some of the uncertainty that seems to be building in this country, that may impact our ability to finance our deficit, finance our debt? I mean, we keep having these auctions and the people keep showing up. The people tell me don't worry about the debt until they stop buying our treasuries.
That's the smartest question I've heard this week. The bottom line is, for our lives, everybody showed up at the margin to buy our full faith and credit. Rebecca, is that at risk?
I think longer term, there's a risk that we see less demand and not enough demand to meet what will have to be increasing supply. So I think that the bias of risk is toward a repricing, a new range for the 10-year yield, which at the end of the day is the cost of capital for all of us and everyone listening to this show.
Final question, Kristina Campmany, just really important. Then how does Invesco see full faith and credit repricing given this turmoil?
Look, I think we've talked about it many times over the last kind of 6 months, is you have to have term premium in the market. Like, you still have a very flat treasury curve, and there needs to be a repricing. So we've talked about 425, 475 range in 10s. We're sitting at or below kind of, the sentiment has pushed us to those levels. We need to reprice the long end higher. And it's not a Liz Truss moment. It's not, we need to be at 6%, 10 years, but we do over time need to price that.
This has been wonderful.
Yeah, thank you.
We can do this again. I think
all-star
every
lineup.
Jobs Day, get them in here. And
on a Friday.
We're enjoying it. We're having fun.
Extra gold stars.
Campmany drove the market. Thank you so much. And our thanks as well to Ellen Zenter, Claudia Sahm, terrific hour here. We thank all of you out on YouTube. Subscribe to Bloomberg Podcasts, and of course on your commute across the nation. Good morning, 99.1 FM Washington, 92.9 in Boston. Bloomberg Surveillance, our economic indicators in this Jobs Day.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Gina Martin Adams, Chief US Market Strategist for Bloomberg Intelligence, joins us here. Gina, it just seems like, we've got the S&P kind of 7%-ish off of its recent high. A lot of this uncertainty really weighing on the market. What kind of conversations are you having with clients these days about how to navigate these times?
Yeah, it varies, frankly, Paul. It's a lot of confusion, a lot of on again, off again. Tariffs have been a big source of discussion for the last month or so. Now we're starting to talk about weakness in the job market that is emerging, not only because of layoffs at the federal level with respect to DOGE, but also because of public sector layoffs. So this week we had two pretty negative employment reports, even though the official payroll report today was somewhat benign. Earlier this week, we got news from ISM manufacturers that their employment prospects are now in contraction. Then we got layoffs announced by the Challenger team that are the highest levels we've seen in a single month since back in the pandemic. So very clearly there is some budding weakness in the economy. But it's coming in small waves and not necessarily in all of the reports at once. And so investors are trying to weigh that out. The other thing that's happening is a non-economic discussion, and that is suddenly tech has competition. Right. So earlier in January, we got the news from DeepSeek. Then this week, we got news from Alibaba that there are competitors emerging in China in the race for AI technology implementation. And that is creating waves in the market as well.
Given the turmoil in the Oval Office, Gina Martin Adams given a tweet on Ukraine, what does a long-term investor do? How do you take part in Bloomberg surveillance, but not let it affect wisdom out 3 years?
I think that's a great point. And because right now we are caught in a lot of short-termism, but there is one big trend that has emerged so far this year that I think will only be exacerbated by the Trump policies, and that is performance of non-domestic stocks, where we have seen over the course of the last several years, U.S. stocks outperform materially in an environment of quote unquote US exceptionalism. US stocks outperform materially. Tech stocks in particular in the US really drove that outperformance. But we're starting to see so far this year a rotation to non-domestic equities. Europe especially is starting to outperform. This is very related to the Ukraine question that you started with. If Europe does ultimately come together with a cohesive strategy for defense spending, with a cohesive economic strategy, with the cohesive strategy to try to promote growth and promote Europe as a European entity, that could be one of the single most impactful outcomes of policy that we're not talking about as much on a day-to-day as maybe we should, but it's starting to bubble up into the equity market. Likewise, China is becoming an investable market once again. As China is coming into the scene for AI competitiveness, we're seeing Alibaba make announcements. DeepSeek made the announcement earlier this year. So we're starting to see a competitive landscape shift in tech, which is favoring non-domestic assets as well. So probably the biggest question you want to ask yourself as a global investor is, should I be continually so overweighted toward the US, or should I be thinking about this new world order creating new opportunities in non-domestic equities? And our view is that non-domestic stocks have been the place to be so far in 2025. They may continue to be the leaders in the global equity markets as we sort of assess the outcomes of this policymaking that's happening from Washington.
Wow, that would be a big sea change, because I think as recent as late last year, Gina, we were seeing reporting about big flows into U.S. equities by international investors, and those days you're suggesting maybe waning?
It appears to be the case, especially because we got to a point where U.S. assets were extremely overvalued relative to the rest of the world. If you think back to 2021, when stocks peaked just after the pandemic, basically every global equity market was overvalued. But when we got to 2024, most global equity markets were actually extremely discounted by comparison to the US. We had built up an incredible store of optimism toward the US specifically through the last several years. That optimism appears to have peaked with 2024, and now we're going through this big adjustment period. As we go through that adjustment period in the US as well as globally, it's allowing for opportunities to bubble up in the rest of the world equity markets. It's allowing for growth to start to recover in those non-domestic equity markets. And we're starting to see capital flow accordingly, not necessarily from the US investor abroad yet, but the Europeans very clearly are investing in Europe. The Asian markets are clearly focused on China. It's up to the U.S. investor if they're going to diversify ultimately. But I think we want to question this idea in an environment in which we are deglobalizing, in an environment in which we are not going to continue to lead the global trade order in the U.S. U.S. multinationals may no longer be the best place to access global growth. Gina, and we have to think about diversifying our portfolios accordingly.
I got 30 seconds. What are you going to think about this weekend? I mean, what's within the massive Bloomberg Intelligence combine? What's your curiosity this weekend?
That's a great question. Hopefully not as much on tariffs, but I'll still be thinking about tariffs. I think we have to think about where these reciprocal tariffs are going to go.
Interesting.
And ultimately what that will mean for global trade. I do think we have to really spend a lot of time on Europe as well. The news out of Germany this week was potentially game changing. Where is Europe going to head with respect to defending the continent against what's happening with Russia and Ukraine? I think that Europe is going to be a big part of the conversation over the course of the year.
This has been wonderful. Gina Martin Adams, and thank you so much.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Anna Wong joins us right now from the University of Chicago. It has been so profound this year that you have the gentleman from Penn, Kevin Hassett, quoting her. Let me read you the first sentence of the PR from Caroline Leavitt, the White House, moments ago. In 1 month under President Trump, the American economy is soaring back to greatness after the economic calamity left by Joe Biden. What is the mathematics of, on a labor basis, when an administration begins? It's not when they put the hand on the Bible. How many months later is it for you?
Well, according to the administration, it would be 6 to 12 months when it becomes Trump economy. But in today's jobs, for me, I thought that the surprising element in the jobs report was that the shrinkage of the federal government is apparently already showing evidence in this report. So one of the reasons why we were expecting a much lower print than today was we expect a shrinkage in the government hiring. Apparently, it's even worse than what we thought. We had expected a slowdown of 28,000 in the government sector. It was actually a slowdown of 33,000.
Okay, I want to cut to the chase here. There's a run rate of non-farm payrolls, which is like the speed of the economy. You are acclaimed for gaining that. Where is the run rate now? And with policy like DOGE, where are we going to be?
Right. So the runway rate based on 6-month moving average is about 190,000. And factor in the overstatement in the birth and death model, it's about 90,000. However, the employment break even to stabilize the unemployment rate has also fallen. So Bostic, the Atlanta Fed president, estimates 75 to 100,000 per month is about break even. We estimate 105,000. So, at a pace of 90,000, it's just slightly below the break even. And so in Powell's word, that means the unemployment rate should be inching up about by 0.1 percentage point every other month. This is why we expect the unemployment rate to hit 4.5% at the end of the year. If you calculate this math of 0.1 percentage point every other month. In terms of the DOGE, we are expecting the federal government shrinkage will lead to about 500,000 federal workers going into the job market this year. So the question is, whether the private sector can quickly absorb this. And in today's print, what we saw, the strength, which surprised me, was in the goods producing sector, particularly manufacturing, which is not a consoling sign, because I think what we're seeing is that with the front running of these goods ahead of the tariffs, it's ramping up manufacturing activity. You see that China's exports are soaring, but that's not a permanent thing. It's definitely a temporary thing. And as all these tariffs come into effect in April 2nd, I think what you're going to see is this steep catch up and drop off.
Moments ago, the laureate Krugman agreeing with Anna Wong that with the mid-month math here, Paul, we're still within a Biden economy with today's statistics. That from Paul Krugman out on his Substack.
So we've had commentary from the administration, from National Economic Council Hassett on Bloomberg Television, from the spokesperson. We just heard White House spokesperson saying this economy is great. The economy is coming back. The president's policies are working very well. Yet the financial markets are not necessarily reflecting that. The stock market's off 7% from its high just recently. How do you think this is all going to play out? Should we be concerned about tariffs? Should we be concerned about changes in immigration? How do you think about that?
Yeah, I think on the tariff front, I think the financial market is calling the bluff on President Trump, because I don't think that a lot of the tariffs are priced in the inflation compensations or financial markets yet. And And I think rightly so for them to be doubtful, because in the past month and a half, it seems that President Trump has been delaying these waves of tariff. And also, I think part of it also has to do with this expectation of a Trump put on the stock market. And if economic activity in the labor market is going to be deteriorating faster because of Doge layoff, it's going to call the bluff on President Trump.
I just looked away from the screen, Paul, to see if my Boost School panel invite was in my inbox. And I look at the lift in the market, Paul. Help me here.
Well, Anna Wong's sitting in a big chair. That's what happens. So, Anna, what are you looking at over the next coming weeks, maybe months, to get a sense of where this economy is going?
I think the fastest indicator you can look at that reflect the rapidly changing temperature of the labor market is the jobless claims, with the federal government jobless claims. And in fact, it is one of the Bloomberg reporters here, Mark Niquette, who discovered that the Department of Labor already published the jobless claims for federal workers yesterday for next week, which everybody thought is only going to be out next week. And we're seeing a sustained increase in jobless claims from federal workers.
I mean, this is a brutal question, a really rude question. You're expert on this, and a lot of us talk. You've lived it. Where are those people going to get jobs? All those Doge exiting people. You could have been one of those people. Where are they going to get jobs?
Tom, that is an excellent question, right? So, for example, in today's jobs report, one of the places which surprised me, where I had forecasted lower job growth, is professional and businesses. And I now saw that much of the pop is in waste management.
Waste management?
Yes.
Always a growth business.
So like when Stevie Nicks, with Fleetwood Mac, when Stevie Nicks was starving, she was in waste management, cleaning houses and cleaning bathrooms. Right? Seriously, where are the people of Bethesda, Maryland, going to get jobs?
But seriously,
Waffle House?
Exactly. Seriously, Tom, that's exactly the point, that the skill mismatch of these government workers who are actually very highly skilled and highly specialized.
What are you, a Biden supporter? Continue.
They're not gonna. They want to find jobs in administrative role, informational sectors. These financial sector, but those sectors hiring pace is not keeping up with the inflows into the unemployment in those sectors. Whereas the places where we need more workers are like waste management and professional businesses. So there's a skill mismatch.
Anna Wong of Bloomberg Economics. She's been on fire over the last 18 months with her analysis of our labor economy.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.
We got to do the papers, and that means Lisa Mateo. Have you recovered from Costco?
I did. I'm good now. It was very sad news, but shares are still lower, about 2%. This morning, you guys are always talking college basketball, right? So wanted to kind of bring it in here, get myself involved in the action. This is from the Post. Okay, so they're saying that March Madness is just that. It's March. They're saying that's failed to kind of bring this buzz to the regular season. They list a couple reasons why. They talk about, they're competing with football, women's college hoops getting more popular because the women actually stay in the sport longer, so people get more familiar with them. Well, there's the guys, they move on to the NBA. Coaches coming, going, the transfer portal, NIL. They say that they've tried to expand the March Madness tournament to spark it. Did that do it for you? Expanding the tournament? Did that spark excitement?
I mean, it's a little bit better. Just get some more teams in there, but you're right. There's more and more. I think, just speaking from the perspective of Duke, all my guys are one and done. And so our connection with our team, and I speak from a lot of alumni, is much, much less. Now, can you extrapolate that out to the entire college game? I don't know. But
so this weekend, it's a huge game. Let's say there's 25 gifted players playing. Are there any seniors?
On the Duke team, none to speak of. So
there's no seniors.
No,
with Jess
North Carolina will have some.
A&M had a seniors day in
that. But again, the transfer portal, for better or worse, it gives the kids freedom to go where they think they can have the most success. So that's great for them, and they deserve that. Now, the downside is there's no stability within teams and programs, and therefore,
loyalty.
David from Washington emails in and says, how much do you think, who's the guy for Duke, the young freshman, Connor?
Oh, Cooper Flag.
Cooper. How much is Cooper piling in name, image, and likeness?
Oh, $6, $7, $8 million this year, probably.
Is a freshman.
Yes.
God, that's Lisa Mateo money.
So
next.
Oh my God. Okay, so the egg shortage drama continuing, prices higher, stores limiting purchases. So now the U.S. is on this like global egg hunt. So they have a goal. Here it is. They need up to 100 million eggs within the next month or two. So they're going out. They're countries like Poland, France, Indonesia to ask about eggs. The problem, like we've talked about, the shelf life isn't that great. Eggs still, they break in transit, and there's flu outbreaks in other countries too.
But I sent Lisa, I sent Alex, I sent Carol Master. I was in the ShopRite yesterday in Jersey. Plenty of eggs.
But they're a little pricey.
Probably a little pricey. I didn't check the prices. You were right. But they were there.
They're there.
So
did they have the signs like limiting purchase?
No.
I opened the old GE. We got the little old GE made in 1950. The engine makes a lot of noise. And there's my $12.99 eggs staring me in the face.
Still, you only got 5 weeks. You got to eat those, okay?
Give me one more.
Bad. The last one. People are, as the kids say, throwing shade at Meghan Markle. Meghan Sussex. Okay, there you want to put it. Her new Netflix show, With Love, Meghan. She cooks, right? She tends to her beehive. She picks berries. But it was this pasta dish that she called single skillet spaghetti that threw people over the edge. Okay, so what she does is that it's an all-in-one dish. She lays the pasta out like raw in the pot, and then she throws the tomatoes, the garlic, and the olive oil, and then she pours the boiling water on top of it.
Really?
So she lets everything kind of cook at once instead of boiling separate.
Does it work?
And so everyone's up in an uproar. They don't like it.
Well,
they say you can't do
Didn't
that.
Martha do that about 1983?
Well, I didn't get past the second line, which says Meghan Sussex.
Yes.
That's her British royal name she goes by. I didn't know that was a thing. I've never seen
that.
That
is her thing now. You have to keep up with the pace.
Oh, I could. There's so many things I could say where Mr. Bloomberg would call me up and Tom, put the surveillance cork in it.
But the reason she says it gives it a creamy texture because it keeps the starch in it. So that's why she does it that way. And it's less pots to wash.
Lisa Mateo, thank you so much. Greatly appreciate it. The newspapers with Lisa Mateo.
This is the Bloomberg Surveillance Podcast. Available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 7 to 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.